This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages. Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at how much of the stock market is passively owned. It could be as much as 19%.
Plus, our new disruptions ahead for the biopharma and fintech sectors.
But first, credit is going to soon end up with a €7 billion monthly buying hole to be filled by markets. And that's as the ECB ends QE in about 3 weeks' time. Want to get more on what the mechanics look like of that. We're joined now by Chief European Credit Strategist for Bloomberg Intelligence, Mahesh Bhimalingam. Mahesh, what does this look like in the next 3 weeks as the the ECB starts to step back from the bond market?
Thank you guys for having me. So the ECB had its governing council meeting and press meet. The headlines were all about what will happen to the rate hikes to control inflation, but an important note was that they are going to stop all of QE by end of June. So from 1st July, there is going to be no more buying of anything, no more net buying. Very important to know that. Unlike the Fed, which is in QT mode, quantitative tightening, the ECB is not in QT or is not going to be in QT. So they will replace any redemptions that are rolling off with new bonds, but there won't be any net buying. So what does this mean? So if you look at what the ECB has done last year they bought about 80 billion euros net and about 100 billion euros gross in credit, which is massive. So just to give you an idea, the net eligible supply for ECB purchases was 80 billion. So the ECB effectively hovered up the net supply, all of net supply in credit last year. This year, with tapering of QE and with ending of QE, the ECB has already bought 34 billion. We predicted 36 for 6 months, and they're going to beat that number because June is still to be there. They'll probably end up somewhere beyond 40 billion, which means every month about 6.5, 7 net, and add another 1.5, we are talking about 8-ish billion gross and about 7-ish billion net that somebody needs to fill as the biggest buyer steps away.
All right, so let's kind of go there. Who is going to step in there? How does the market kind of thinking about this as it evolves? It's not just Putin's invasion and inflation fears that have rocked European credit. Given inflation was going up, markets feared that the ECB will end QE, and this has been baked in to spreads for some time. So this is not genuinely new news. People were expecting that the ECB will stop QE because, unlike the Fed, the ECB has a single mandate, which is inflation control. And if they need to hike rates, because the ECB is a rules-based bank, given that it governs about 20 countries, the ECB has to stop QE before it hikes rates. So what does it mean? It means that the market was pricing in that the ECB will stop QE in June. So to answer your question, is the market going to sell off more on the back of this news? A little bit. So we saw some weakness. The problem, to answer your question better, is in case there is any further bad news from Ukraine or inflation continues to be too strong, there is no more backstop. Mm-hmm. That is the main deal.
But Mahesh, is that entirely true 100% going forward in that Christine Lagarde in the press conference did talk about how fragmentation is a huge risk. Watching peripheral spreads, for example, it does seem like there is a willingness in the ECB to do something to help monitor spreads. So it doesn't feel like they're out of the market at some point altogether.
Right. Good question. So in terms of the ECB's aim now, one, because it has to control inflation, they won't be buying any corporates net. They might be rebalancing into peripheral govies. So example is, let's say a bond matures they will use those redemption funds to buy BTP. That is what their spread control tool is right now. But the market is not happy with it. The BTPs are wider by 20 basis points plus. So clearly markets are not impressed with saying, I'm going to use the redemption funds to slightly rebalance into peripherals if needed. That's not good enough. If buying net is not going to be good enough, tweaking those redemption amounts is not going to be enough in case there is any further crisis.
Mahesh, here in the United States, there's a lot of investors feel like the U.S. Federal Reserve is behind the curve. If that's the case, where is the ECB? They're just getting started. It seems like they're just tiptoeing here. How does the market think about that?
Yeah, to some extent, it is certainly true. But you need to realize the U.S. has a demand-based inflation problem. Europe is largely a supply-based inflation problem. So in the U.S., there is a very strong case for the Fed to go strong every meeting. In Europe, there is less of a case. But that said, I totally agree that what they announced today, that there is going to be just a 25 basis point hike in July, and in September, they are thinking about something at 25 basis points plus.
Thanks so much, Mahesh. We really appreciate it. Bloomberg Intelligence Senior European Credit Strategist, Mahesh Bhimalingam.
Coming up on the program, we head to the fintech sector and look at the big three.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, let's talk fintech. One of the really, fascinating stories in the marketplace today. A lot of investors are looking at fintech, and I'm sure people spent a lot more time when they were in lockdown doing their finances from home, but it's been a big growth area. Let's bring in Julie Chariell. She covers the space for Bloomberg Intelligence. Julie, when we think about fintech, I think about, using my bank app and depositing a check, but there's a lot more out there, obviously. How do you think about, and how do you suggest to investors that they look at this space that for a lot of people is kind of a white space?
Yeah, so fintech is really interesting. You have the consumer-facing stuff, which we're all used to seeing with our digital wallets and apps and things. But then there's so much that goes on, as you said, behind the scenes. The infrastructure of fintech is where it gets really complicated. But that's also the stuff that, even when things are slowing down, all those transactions are still happening behind the scenes, and those companies who are making those happen still have a lot to do. So they're kind of emerging now as the defensive names. As we see some of the high PE, high growth tech stocks and fintech stocks begin to slow, see some pressure in the market, these back-end companies, these processors that make all the magic happen kind of behind the scenes are getting more attention now.
So what kind of companies are they? That do the stuff, the infrastructure part of it?
Yeah, so the biggest companies are kind of the big three now after a big round of consolidation in 2019. So you have Fidelity National, Fiserv, and Global Payments. Not household names in fintech, right? But they've been around for a very long time, serving the banks who are card issuers, and for bank IT, if you think about outsourcing of IT systems for banks, which is a huge business. And then on the merchant side or the seller side, where there are just companies out there, retailers who want to offer credit cards and payments and buy now, pay later. They need a processor on the back end to help execute those transactions. This is what these companies do.
And explain to us how their businesses were impacted from the pandemic and maybe how they're a little bit different today than they were going into the pandemic.
Yeah, because that merchant processing side, right, letting a retailer accept a electronic payment, because that was initially impacted in the early days of the pandemic, just as consumer spending slowed down, everyone just kind of froze, didn't know what to do. Those companies did see some declines in revenues, but they've been coming out of it pretty nicely. These companies have been around for a very long time, and a lot of their retail customers are those brick and mortar stores who are really coming back into favor now. E-commerce was very strong on the pandemic, but growth there has slowed. people are excited and happy to be out and about. They're going back into stores. So those merchants who these processors primarily serve have been doing quite well, and their merchant businesses are growing above average, 9 to 11%, which is pretty good off companies that are, 10, 15 plus $billion in revenue.
Julie, we talk a lot about how the consumer is transitioning to services rather than goods, right? I'm going to go on a vacation and not buy that fancy dress or something like that. How does that affect the fintech players?
So these companies in particular are quite broadly diversified when it comes to vertical exposure. So they have a good amount of exposure to travel and entertainment and restaurants, which are doing well, as well as exposure into retail and consumer discretionary. Consumer discretionary is probably about 60% of their business. That may begin to slow a little bit if the economy is slowing and prices are ticking up. But as you said, those services pieces, which are anywhere combined that group between 10 and 15% of their revenue, continues to be quite strong. Plus, these companies are largely paid on the dollar amount of the transaction. They get a fee on that amount. So as inflation is lifting the size of every transaction, that actually benefits them.
So I'm looking at some of the numbers in your research note here, Julie, and one of the things that jumps out is free cash flow. I like free cash flow. What are these companies? They generate a lot of free cash flow. What do they do with it?
Yeah, so they do lots of good things with it that investors should like. So their free cash flow is about in line with their net income. So it's a good cash story. They're investing, but there's lots of scale in this business. So while they're growing, into those high single-digit growth numbers, they're generating lots of free cash flow, lots of scale and operating leverage from that. So two of the three I mentioned offer a dividend, Fidelity National and Global Payments. They all are buying back shares. Anywhere between 3 and 5% of shares outstanding are bought back every year. And then they're continuing to invest because there's a lot happening on the bank technology front. Right? Banks are anxious to catch up to fintechs with everything that fintechs are doing with consumer apps and P2P payments and consumer wallets. And so these companies are also putting some investment toward helping those banks modernize. And that's another part of the growth story as well.
Can I just get specific for 1 second about some of those consumer things? And this is something I'm just curious about. The buy now, pay later situation. With Apple saying that they're going to do their own buy now, pay later, like how disruptive could that be for this part of the fintech market?
At this point, it's not particularly disruptive because Apple, for the most part, is working with partners. Okay, so they have processing partners. Fidelity National is one of them. They work with MasterCard on the buy now, pay later side to tap into the MasterCard network to actually complete those transactions. We know they work with Goldman on the credit granting side. So right now, we don't see any big threat to these back-end providers. There has been some talk that Apple wants to do some of the card issuing processing, which is a smaller part of what these companies do on their own. Not clear how far along they are yet. I don't think it's going to take away from the opportunity for these companies as long as it's integral to Apple only, and I'm not going to sell it to other card issuers, which would be quite a ways down the road. But we're starting to hear some inklings that Apple wants to do a little bit more on its own. So far, though, not the case.
All right. So for these three names that you have in your research report are Fidelity National, Global Payments, and Fiserv. How about those stocks done? Because I know that the tech stocks have been under some pressure so far this year.
Yeah, it's really interesting. So if we look sort of year to date, fintechs overall have been down about 10%. The really high flyers in that post-pandemic period are off as much as 50%. These companies are on the other end of the spectrum. So they're flattish, maybe down a couple of percentage points, similar with Visa and MasterCard, other sort of fintech infrastructure plays. So these really have already been seen by the market as defensive plays. And we think that they're going to remain in that category as things potentially get a little rockier in the second half with inflation and interest rates moving higher.
All right, Julie, awesome. As always, talking fintech. Our thanks to Bloomberg Intelligence analyst Julie Chariell.
All right, coming up on the program, just how much of the U.S. stock market is passively owned? We're looking at least 19%. We'll break down some of those implications.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time tapping into Bloomberg Intelligence analysts covering some 2,000 companies in 130 industries worldwide.
About 19% of shares of the average publicly listed U.S. stock are owned by passive funds. And this is a calculation done by James Seyffart, who's the Bloomberg Intelligence ETF analyst. His whole team kind of crunched the numbers and came up with that number. Let's dig into why this is significant. James, good to see you. Good to chat with you. How did you come up with that 19%?
Yeah, so there's actually a tool I've been using for the past couple of years to try and understand how much of the market is passively owned. I mean, from Musk to Michael Burry to Cathie Wood, a lot of people are talking about passive and what it's doing to the underlying. Now there's a lot of talk about proxy voting. So we've basically built a database that's available on our dashboard so anyone can go in and look at a stock and say how much of its underlying is passively owned. So that's why we care about it. We want to track it going forward so that if anything does happen, people can come to this and see exactly what the data is showing rather than talking about hypotheticals. We actually know roughly what it is.
All right, for those listeners that are Bloomberg Terminal users, what is your dashboard and how did they kind of get there?
Yeah, so you could just, if you're on the terminal and you just type in the command line BI space ETF, it'll bring you to our ETF dashboard. On the left-hand side, there's an option for passive ownership, and we can look at it at the index level. We have it available for a few indices, and we have it available for about 3,000 individual stocks going back historically for a few years.
Very cool, the stuff they're doing.
It is. It's really cool. So what's the so what here? So you get to the 19%. Why is that significant?
Well, there's a few people out there that are talking about, so one, active managers like to say it's bad for the market. There's a little bit less evidence that it's definitively bad for the market. There are arguments that the constant money flow going to passive is impacting higher weighted stocks and indices a little bit better. But anytime there's something really bad in the market that happens with an individual stock, money is still pouring into these funds, and those stocks still get crushed. So what we see is that overall, active managers still in charge, but on the fringes, the constant inflow to these passive funds that have certain weights might be impacting on a intraday basis or a daily basis. There's basically an underlying drumbeat of flows. That's the way we kind of view it. But again, everyone wants to talk about this and try to understand what's happening, and there's just not a lot of information out there.
All right, so 19%, that seems like a big number to me. Give us a sense of kind of where that is relative to his history. Is that number going up, and kind of where do you guys think it may go over the next several years?
Yeah, so, I mean, going back to 2013, it was probably around 6-7%, depending on what you look at it. And there's a few different ways there's two different ways that I'm mainly looking at this. So there's the weighted average version. So you basically, the higher the weight the company, you take the percentage passive and you weight it higher. So when you look at the S&P 500, you get about 19%, same with the Russell 3000. But when you took the simple average, the S&P 500 is about 22%. So basically it's saying that some of the lower names in the S&P 500 have a higher passive ownership. And there are a few different stats that go into definitely determining what becomes higher or lower passive ownership.
Going forward, I'm wondering too, if we get more mom and pop traders into the market, et cetera, does that take away from this kind of passive investing? As I feel like during the pandemic, trading options and bidding up GameStop was the fun and cool thing to do.
Yeah, so I mean, there's a lot. So this isn't my team, but Larry Tabb's team and Gina Martin Adams have covered the effect that retail has happened. And from their point of view, retail is largely less since that huge mania we had in early 2021. But again, even through that time, this number has continued to rise. It's not like it's a straight line up, but it's going up. It's a consistent trend upward. We have the data. We look at it quarterly, and it's constantly heading on an upward trend. So even if the retail does come back and they're using derivatives, we're still seeing money leaving actively managed funds and going to passively managed funds. The other side of this is this data is only looking at passively managed index funds or index mutual funds and ETFs. The other side of this is CITs, SMAs, these private portfolios. We can't see them, and we know for a fact there's trillions of dollars in passive assets. So this number that we're using is likely a bit of an underestimate of how much is owned by passive vehicles.
James, do we know passive investors, are they more likely in bigger cap stocks, more liquid stocks, versus maybe some we'd find in a Russell 2000? Does that skew at all?
So that's what a lot of people think. That's what Michael Burry talks about. That's what Cathie Wood talks about.
It makes me like, you're wrong, Paul.
I'm wrong. It's a polite way of saying I'm wrong.
Yeah, well, you think about it logically, and that's what makes sense, right? But that's not what's happening. What ends up happening is names that are in real estate, utilities, smaller mid-cap, small-cap names that get bought by these dividend funds, these real estate funds, things looking for yield. They're smaller caps. So one, they end up getting, the more that passive funds own them, it's a much bigger portion of the market cap. The other side of it is some of these names, some of these big company names they have a really low free float percentage, whereas like a real estate utility is going to have nearly 100% of it is available to investors. Whereas Walmart, for example, is only 8.8% passively owned, largely because 47% of it is owned by the Walton family. When you make an index, you use the free float percentage, or you take into account that when you're looking at the market cap. So all the things with really low passive ownership are either basically they just recently IPO'd and came in the market, or they have extremely low free float percentages.
James, there's a lot of math in your work. I'm not sure I really am comfortable with that. Your analysis.
I've read your research from when you were in BI. I know that's not true.
It is. It totally is not true. James, thanks a lot. Really great stuff. Bloomberg Intelligence analyst James Seyffart.
Coming up on the program, how the growth of green hydrogen is impacting the demand for platinum.
You are listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
The green energy transition is a big one that's happening worldwide, but all of that requires more things, whether it's actual power input, whether it's copper, whether it's lithium, whether it's cobalt, whether it's palladium or platinum. And therein lies part of the problem as we transition into a new world for energy. One part of that is green hydrogen. Its technology growth could boost platinum demand by nearly 700,000 ounces a year by 2030, and that number could even double in the next 13 years. We're joined now by Grant Sporre. He's Bloomberg Intelligence analyst who covers all of this for us, metals, mining, and commodities. It's so interesting, Grant, because we're trying to go green, but going green is going to cause shortages and other stuff. Walk me through how you modeled the green hydrogen revolution.
Sure. Thank you for having me, Alex. Look, firstly, I must say that platinum is probably one of those metals that needed to reinvent itself. So from 2015, it had the Dieselgate scandal, which has meant the platinum market has been pretty much oversupplied since then, and that's weighed on prices. While and even today, its price is pretty depressed versus many of its sister metals. So I think the hydrogen economy could actually be one of the saviors of platinum, particularly as we head towards the end of the decade. So the way I've looked at platinum demand is there are essentially three types of applications where platinum could play a decent role. One is simple green hydrogen production and storage. The second one is actually producing electricity from the hydrogen that you produce. And then the biggest one, or the most likely biggest application, is going to be road, and then later in, or perhaps in the next decade, marine transport applications. So those are going to be the three main drivers of platinum.
All right, so let's say I want to go get my hands on some platinum. Where do I go? How do I get it? And is there enough there?
Well, here you go to the jewelry district. But,
okay.
But otherwise, it's a bit different.
No, so if you're going to use platinum in industrial applications, you don't actually want the solid metal. You want a sort of a product that is called sponge. It's easy to use. You can smelt it very easily. You can make chemicals out of it, etc. So typically, what you would do is you would go directly to one of the main suppliers, which would be either one of the refiners. So from recycled materials. So that could be your Johnson Matthey's, your Englehart's, your Umicore's, or you can go to the mining companies like Anglo American Platinum, Impala Platinum, or somebody like that, directly for your metal. So that's how you would get it. And as I say, at the moment, it's been in oversupply for a number of years. So there's actually plenty of stock floating around, and it's actually quite cheap. So that's an added incentive why technologies looking at developing in hydrogen would look to platinum, because certainly it's relatively plentiful versus demand right here, right now.
So, Grant, I hear your point that platinum really needed a catalyst, and it needs that kind of demand pull. I get that. If you use it for something like green hydrogen, is platinum in and of itself green?
So very, very good question. I think, and this is probably a broader question to the mining sector as a whole. Is how are you extracting that metal out of the ground? And yes, we do have to expect. We produce CO2 emissions in doing that. We probably leave a mark on the landscape, and the same could be said for lithium, copper, and everything. But the mining industry has been taking great strides in trying to do that. So, for instance, Anglo American Platinum, they've just come out with the first hydrogen fuel cell truck. So instead of using diesel trucks to dig up the platinum ore or the PGM ore, they are actually going to use hydrogen fuel cell vehicles. Now, it's obviously still in trial, but those are the sort of steps that the miners are taking, as well as trying to use as much renewable energy as they can.
So I know from your research, Grant, that platinum, they use a lot of platinum in automobile manufacturing, and I know they're just not making as many cars as they did pre-pandemic, whether it's supply chain issues or whatever. What does that mean for the price of platinum and kind of the whole supply and demand scenario?
So what I would say is it's difficult to look at when you look at tailpipe catalytic converters. It's difficult to look at platinum in isolation. One has to look at it in conjunction with its sister metals, palladium and rhodium. And I think the thing there is that platinum is a much more versatile metal, so it's got quite a lot of end uses other than just auto catalysts. Whereas the more vulnerable metals are palladium and rhodium. And that's where I think, and in fairness, those metals are in deficit at the moment, so prices are elevated. But as we move towards the end of the decade and we see more battery electric vehicles, that's when the switch comes, when those two metals will be in oversupply and platinum will be a lot more balanced. So, there's this sort of this trend that's going to unfold over the course of the rest of the decade.
Grant, love it. Really interesting. Thank you so much for joining us. Grant Sporre, Bloomberg Intelligence analyst who covers metal and mining.
We turn to biopharma now. I love these biotech stocks because it just seems like it's a binary situation. Either it works and then you're rich, or it doesn't work and then maybe not so much. So let's talk about a company called Jazz. For more, let's welcome Bloomberg Intelligence analyst and Hunter Van Kirk. And Hunter, thanks so much for joining us here. Talk to us about Jazz. What do they do? Where are they in their process?
Absolutely. So Jazz is historically known for their narcolepsy medication. They have a huge sodium oxybate franchise, which really launched the company. But recently, they've been diversifying away to expand their offerings. And I just met with them, had a lot of time at the ASCO meeting with the CEO. Oncology currently comprises about 20% of their revenue, and they've been, actively diversifying into these other areas. They acquired a cannabinoid company called GW Pharmaceuticals last year, as well as several new candidates through in licensing deals. And that's an area that we see that we think they'll really expand into going forward. We think there'll be a lot more business development there.
So what does their pipeline after that look like?
So the pipeline now, there are a lot of oncology candidates, which is actually what they were, focused on at ASCO. They showcased a lot of data on some key drugs that are already commercial, but could see additional indications, as well as new dosing regimens. That's Rylaze, that's Zepzelca, Vyxeos, all areas where there are kind of incremental value adds to come down the pipeline. But probably more excitingly, they are on the cannabinoid space. There's nabiximols, which they are expecting to file an IND this year. And additionally, the two in-licensing deals that they've done recently, one was for an interferon alpha candidate with Werewolf, and another oral orexin-2 receptor agonist with Sumitomo.
All right, we're talking about Jazz Pharmaceuticals. I'm just punching up on my screen. JAZZ is the ticker to put into your Bloomberg terminal. I see it's got about a $9 billion market cap, so good size there. Stock is up 17.5% this year, so it's been a good performer. So AH, what's the market thinking about here for this name? Do they want to see this company? Are they owning this company because of the R&D of this company, or do they own it maybe for the growth prospects associated with some acquisitions?
Jazz has historically always had a lot of free cash flow. Consensus expects about $1.2 billion this year. But most recently, that's been kind of tied up in this acquisition, the GW Pharma acquisition that they did last year. Management has set a leverage target for under 3.5 times by the end of the year, which in our conversations, they may be able to hit that early, and that would really free the company up for some larger deals, we think, end of this year, next year. And until then, we really see the idea of some licensing deals coming through. They have certainly always focused on commercial or near the market, near commercial assets. They've highlighted interest in movement disorders, and certainly anything that goes along kind of their three pillars in the neuroscience, the oncology, anything that would be an inner pipeline opportunity.
Do they have anything to do with COVID at all, whether it's recovery or treatments or anything like that?
Not too much in the COVID space. They're kind of your classic, spec name that they have these little areas and that's where they've focused and that's what they know how to do and they do it well.
So, I'm thinking about your space here. These companies, I think they're just fascinating. Some of these pharma companies and biotech companies, and boy, as an industry, didn't they really come through for everybody for this pandemic in terms of getting the vaccines? How do you think about your space, Hunter, in terms of, do you look for companies that you want to back management, or do you look for companies who are in a hot space? How do you and biotech and biopharma kind of analysts and investors approach the space?
That's a great question. I think it's really a little bit of both. You definitely need to hit on kind of all parts. It's a very sensitive industry to always having the next pipeline candidate. As we've talked about, you need to have something that's first, that's competitive, that has the patents behind it. To keep your exclusivity, and you certainly need a management team that knows how to hit its targets, how to get things through the FDA approval process, which is expensive and long. And if you get, any sort of delay there, that's certainly setting you back in the time that you'll be able to market your drug, because on the other end, you'll lose exclusivity, and then there'll be generics, and that's the end of your time to. Yeah,
that is a tough business.
Yeah,
I like my media business where you just have to go watch movies and TV shows.
Yeah, but then you get cool names like Jazz and Werewolf. Come on.
Yeah, that's true. That is pretty cool.
Awesome.
All right, Hunter Van Kirk, thank you so much very much. Hunter Van Kirk, she covers all this good healthcare stuff for Bloomberg Intelligence.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on some 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It is 57 minutes past the hour, and this is Bloomberg.